As a nucleus for high-tech innovation and economic growth, your economic vitality is critically important to the nation and to the global economy. Despite your impressive track record for job creation and high wages, you're not immune to the economic challenges that we're now facing across the nation. While housing conditions are softening in Silicon Valley, like most of the country, home prices remain very, like most of the county, home prices remain very high. San Jose actually is the most expensive housing market in the nation, and more than half of San Jose homeowners spend at least a third of their monthly income on housing. Rapidly escalating home prices have been a driving force behind the growth of the so-called non-traditional mortgages during the past few years in what is known as the Alt-A market. These are higher-risk mortgages typically given to borrowers with good credit. Many Californians have them. As home prices rose, one way to keep the monthly payment in check, for a while anyway, was to take on an interest-only or payment option on mortgage. These so-called affordability products permitted zero or negative amortization of principal in the early years, but that was followed by potentially large increases in the monthly payments once amortization kicked in, typically after 5 years. As long as rapid home price appreciation was the norm, these loans caused few problems. Homeowners could simply refinance out of the mortgage before the payment shock kicked in. Now that prices are falling, we see more people running out of options. With insufficient equity to refinance, some are facing a doubling of their monthly mortgage payments. 85% of those with payment option loans currently owe more than they did when they originally took out the loan. And about 75% of these borrowers have been making the minimum payment. Non-traditional mortgages were also the instrument of choice for investors and speculators hoping to flip the property for a quick profit, only to see the market turn on them before they could do so. The problems associated with these products are already very evident. We're seeing a rash of first-year defaults among Alt-A loans to speculators and borrowers who should never have been qualified for the loan in the first place. Problems from lax lending began to spread last year in the subprime market. Unlike Alt-A, subprime mortgages are high interest rate mortgages given to people with scant credit records or blemished credit histories. Until recently, the majority of loans made in the subprime market were so-called 228s and 327s. These adjustable rate loans have initial 2 to 3 year starter rates of 7 to 9%, with steep increases in payments after the initial period. Frequently, these loans were given to families already struggling to make ends meet, who were encouraged to buy or refinance homes with loans they never had a realistic hope of repaying. And a disproportionate number of these loans were made to working class and minority neighborhoods. As with Alt-A mortgages, these loans performed as long as home prices went up and interest rates remained low. That allowed borrowers to refinance out of them before the payment shock, generating fees and prepayment penalties for brokers, lenders, and investors. Originators in search of loan volume aggressively marketed them to subprime borrowers, who, by definition, either had troubled credit histories or very little experience with borrowing money. In addition to payment shock features, both Alt-A and subprime loans typically had other high-risk elements, such as the lack of income verification, the so-called stated income or liar's loans, high loan-to-value ratios, as well as second liens. As home prices have fallen in many areas of the country, distress in the mortgage markets has intensified. More and more borrowers are unable to refinance out of unaffordable payment shock loans. And an increasing number of borrowers are finding themselves in a very tough spot, owing bigger mortgages than their homes are worth. When borrowers stop paying on their mortgages, the standard response of many loan servicing companies has been to initiate foreclosure. In a rising housing market, this might be the best course of action for the investors who own the loans. But in today's troubled housing market, a policy of mass foreclosures is self-defeating for investor and borrower alike. Mass foreclosures are costly and damaging to neighborhoods and communities. They add housing stock to markets already laden with high inventory, and they can result in even bigger losses for investors. A better alternative is to modify the loans. That is, renegotiate the loan terms between the borrower and the lender. This takes into account both the changes that have taken place in the marketplace and the high cost that foreclosure imposes on all parties. Loan modifications are a standard practice for lenders and borrowers who have long-term banking relationships with the bank typically holding the loan. But it's much tougher today because virtually all these problem loans have been sold, pooled, and resold as securities to investors. When the loans are securitized, they are serviced by third parties under so-called pooling and servicing agreements. These agreements typically require the company servicing the loan to collect payments and, if there's a problem, maximize recoveries for the pool. Unfortunately, many servicers have tended to proceed directly to foreclosure. Some servicers have told us that they are afraid to systematically modify loans for fear that investors will sue them. And since I'm speaking to a high-tech group, I assume that all of you know about investor lawsuits. But the smarter question I think loan servicers should be asking is whether there's a bigger risk of a lawsuit if they don't do modifications. Given today's market conditions, foreclosures will likely cost investors a lot more money than the lower returns they would get from modified loans. If need be, I believe Congress should step in to protect loan servicers from investor lawsuits by clarifying that systematic loan modifications are consistent with, if not required by, their fiduciary obligations to investors. One simple modification that I have called for is to extend high subprime starter rates for 5 years or longer for all owner-occupied homes where borrowers have been making timely payments but can't afford the higher reset payments. Such a systematic approach can be much faster than a loan-by-loan process. And speed is crucial, especially for subprime mortgages. Some 1.7 million of them will reset in the next 2 years, most by the end of this year, and a lot of them concentrated in California. Going forward, one thing is abundantly clear. The home mortgage market needs strong rules. Much of the lax lending I have been talking about developed outside the regulated banking sector by lightly regulated mortgage finance companies. However, as these non-bank lenders increased market share through aggressive use of easy credit, some of the larger banks and thrifts also began easing credit standards, which widened the mess we are now in. We need rules that restore common sense and basic notions of fair play. We need rules that apply across the board so they protect all homeowners, regardless of who their lender is or what state they live in. We need rules that apply to banks and non-banks. We need to protect responsible lenders from the downward spiral of race-to-the-bottom competition. And we need rules that restore transparency to a secondary mortgage market now frozen because of uncertainty and distrust. When you stop and think, it's astonishing that with mortgages being by far the largest single financial asset for most American families, there is no regulatory regime that applies consistent across-the-board standards to protect all borrowers. Compare that with the securities industry. Brokers are subject to fairly rigorous testing and licensing requirements that are administered by strong self-regulatory organizations. Federal law provides for effective enforcement through these organizations and the SEC, as well as private rights of action. And suitability rules apply to all securities investors, which in turn give legal incentives for brokers to take extra care in recommending investments. So what does this boil down to? It means that your legal protections may be greater for a $2,000 mutual fund investment than they are when you buy a $300,000 house. Ronald Reagan once said that the purpose of government is to protect us from each other, not to protect us from ourselves. Markets work best when consumers are able to understand the products and services they are getting and the prices they are paying for them in arm's-length transactions. Markets break down when prices are hidden, when essential product features are too complex to understand, and when there are gross disparities in the knowledge and sophistication level of parties to the transaction. The recent problems in the mortgage market and the economic harm that they are causing clearly show the need for government to protect us from each other, with basic safeguards that provide a floor of protection as markets change and evolve over time. Traditionally, downturns in the real economy led to problems in the credit markets. Today, it's the other way around. Pervasive lax lending standards in the credit markets are contributing to stress in the real economy. And that means that as leaders of the real economy, that means all of you here this morning, lax lending should be of great concern to you.